Okay, so let's get started. So, first of all, thank you for joining us on behalf of the Detroit Regional Chamber and the Detroit Promise and the Alumni Association. I would like to thank you all for joining us again today for our final webinar of the 2023 Kickoff to Financial Freedom Series. I'm Shantae Kane, the campus coach from Macomb Community College and the Alumni Success Coordinator. Yes, I have two titles. Love it. We here at DRC have listened to the topics of interest for our students and are so grateful to have leaders in the consulting and banking industry provide webinars for our financial literacy program. So today's presentation is purchasing your first home. I know I'm very interested in this topic as someone who has not purchased a home yet and looking forward to that experience. And so feel free to submit questions, as I mentioned, during the chat, as well as Ella has told us that we'll be able to ask questions in the question and answer session in the middle of the presentation briefly. We will definitely get those questions answered for you, and stick around for some important information after. So without further ado, please help me welcome today's presenter, representing Bank of America, Alan Kalute, community leader. I'm sorry?
Caluette.
Caluette, I messed that up even though I practice. Caluette, community lender officer and home buyer education specialist. Thank you, Alan.
Well, thank you for inviting me. I'm actually very proud to be presenting to you. I've been in the metropolitan Detroit mortgage finance industry for over 30 years. I've done many transactions, a lot of different scenarios. So I'm well versed. My main focus is to help structure finance deals, finance purchase transactions for either first-time home buyers or people that are purchasing their primary residence. Doesn't necessarily need to be their primary or their first-time home buyers. And I'm very fortunate to be working for Bank of America. You're going to figure out throughout this presentation that our commitment to our community is so strong, it makes my job easy. So if you want to go to the first or the second slide. Right now you're living where you're living, and most likely you're not owning the home, but either renting or living rent-free or other arrangements. But you're going to have to ask your question, is buying a home right for you? It has to be based on your credit, your income, your savings, your intent, your employment, whether or not you want to relocate before buying a home. All those factors come into play. But the key is that you want to eliminate the risk of renting, because you don't have control over the cost. Landlord does. So there's a lot of risk associated with renting. And there's a lot less risk. In fact, there's a lot more wealth creation when you purchase. So if you looked at this slide, it's all about eliminating the risk of living on someone else's terms. Can we go to the next slide? There's obviously advantages and disadvantages of home ownership. As you look at your own personal life scenario, you're going to say the disadvantages is, well, maybe it's the neighbors, or maybe it's the cost, or maybe it's just you prefer to be self-reliant. As you go through this list of disadvantages and advantages, the advantages far outweigh the disadvantages. And you're going to realize that you're going to have a lot more control of your life when you actually own homes. So let's go to the next screen. Bank of America has a commitment to the communities in which they do lending in. And there's many, many communities throughout the United States. But our commitment, well, is very strong. The reason being is it's very strong because we put $15 billion into a kitty in which we are giving money away in a number of different loan programs, which first-time home buyers and people purchasing their primary residence, could be the second time, could be the third time, they can have access to our grant money, which is going to be dependent upon income, where the location is, credit, things of that nature. But we're very generous, and it's very easy to qualify for our income or for the grants. We have a number of loan programs. One's called the Community Affordable Loan Program. Another one's called the Affordable Loan Solutions Program, which will allow you to put as little as 3% down on the home. When I say you put 3% down, we're giving you the money. We'll give you the money up to $10,000. So our loan programs, what they really do is they significantly reduce the amount of money that purchasers need to purchase a home. And I've received many questions, and I'm going to answer the most relevant one is, what does the actually homeowner have to pay for? They have to pay for the future taxes on the property and the future insurance on the property in the form of escrow accounts, in the form of paying your homeowner's insurance the full year. I want to stop right now and give the audience time to come up with any questions, because that's a pretty powerful statement when they only have to pay for insurance and taxes. So I'd like to find out if anybody has any questions. How about a show of hands if anybody is impressed? If we can see a show of hands. I'm not able, oh, there's some movement there. There we go. Thank you for your hands. Let's go to the next screen. It's important for you to understand the down payment and the various programs that we have that's required. What's important is that we have our grants out there, and I'm going to be going over them in a little bit. What other areas of our community, including state and local agencies, nonprofit organizations, cities, employers, they may also have grant programs. And the vast majority of those grant programs are eligible to use together with our grant programs. So again, this is just layering grants to help you finance a home with the least amount of money possible. So the grants can be used, and I'm just going to go over this real quick, for the closing, for the down payment, for the closing fees, your monthly payment assistance. And these grants are going to be dependent upon your income, your location, the price of the home. Sometimes it's a first-time home buyer. We have grants that are not dependent on whether or not you're a first-time home buyer. Let's go to the next screen, and I'm going to go over the first grant that we have, the down payment grant. This grant will pay 3% of the purchase price up to $10,000. We're giving you that money. And the minimum down payment for our loan programs is 3%. So you're actually not even pulling money out of your pocket to pay for the down payment grant. And once you receive the grant, basically, which happens at the time of closing, after you receive the grant and the money's yours and you're in the house and you have the keys, you're not allowed to pay us back. If you can get relocated the next month because you accepted a better position at your employer or a different employer, whatever the case may be, and you put your house on the market, you're not required to pay us back. You're not allowed to, in fact. There are things that when you use the down payment program, you are required to take a home buyer education course. And again, this can be layered on with additional grants, which will significantly lower the amount of money. And I say significantly lower, you can purchase a home with a few $100s with all the different grants. But you are required to take the home buyer education course. That entity that gives you that course, they're going to be HUD certified. And once that's complete, they can provide you a copy of their certification, which I will need a copy of, so that when we submit your application, everybody knows that you're eligible for the grants. Does anybody have any questions pertaining to the down payment grant? So 3% of the purchase price, meaning that up to $10,000. So that's if you buy a $300,000 home, we're going to give you $9,000 because we didn't hit the maximum of $10,000. You could actually buy a $333,000 home and we'll give you $9,999. And then you don't have to come up with any money for the down payment. The key here is that the maximum down payment, because you can come up with money, but the maximum down payment on the home is 20%. If you decide to put more than 20% down, this grant and all other grants go away. So as far as a strategy, you may be able to afford to put more than 20% down, but you most likely do not want to. And this is the down payment grant. That's strictly just for the down payment. Let's go to the next slide and look at our next opportunity. The American Home Grant. This one is beautiful because it's very generous. It's up to $7,500 for your one-time closing cost items, meaning the reoccurring cost, this does not cover. The recurring costs such as your taxes, your future taxes on the property, and your insurance, that's a reoccurring cost. And if, let's say we close on the 15th of the month, your first payment would be due in 45 days. So those first 15 days of interest we're going to collect from you, this grant will not pay for it. By the way, if we close in 45 days, that first payment pays for the previous month, not the future month. It pays it in arrears. What's nice about this is that your closing cost, your one-time closing cost items typically don't even come close to $7,500. They may hover around from $2,500 to maybe $3,000. You say, well, what are we going to do with the rest of that money? Because you can't take any of it home with you. You can't put it in your pocket. You can't use it towards a down payment. We can't use it towards any other fees. So what we do is we basically pay points. Paying points is the philosophy of you're paying for a lower interest rate. So you're going to pay for a lower interest rate. So we're going to give you this extra money. We're going to apply it to points. Each point is a percentage of the loan amount. But we apply it to the points and we see how much of a lower interest rate can we give to you. And the key here is that we're already competitive with our rates. So when we give you money to purchase this lower interest rate, we're going to get a below market interest rate. So not only are we, and again, we can layer these grants, not only are we giving you money for the down payment, but we're going to pay for all your closing costs. We're going to give you money to pay points to purchase a lower interest rate. And to my knowledge, I don't have any competition. Bank of America does not have any competition when we layer these two grants together. I'm looking forward to hearing some questions from anybody at this point in time, because this is very powerful stuff and it really puts you in an advantage. And I realize that most of you, in fact, if not all of you, are first-time home buyers, so you're just getting into the market. And this is all brand new to you, but what I'm presenting you, this didn't exist a few years ago with any company. And now we're in a position because of our commitment to our community to help people purchase homes to increase their net worth.
We
That
do have a,
benefits the community and it benefits the bank and it benefits the individuals. Go ahead with your question.
yep, Ellen, we do have one that was sent in privately. Let's see what we have. How do we go about stacking grants? Which one do we apply for first?
Well, you're not applying, well, these two, they go in conjunction with one another. They happen simultaneously, the American Home Grant and the down payment grant. If you want to stack other grants, meaning, let's say that you went to the city of Detroit or the city of Westland or the city of Livonia. Now, I've picked everything in metropolitan Detroit and Wayne County, but there are other cities and entities that have grants. National Faith is a home buyer education entity that provides a home buyer education, but they also teach you on what cities have other grants. So you would contact National Faith and they'd find out where you plan on purchasing, and they do their research and they say, okay, it's Livonia, Westland, whatever the city, as long as the city has it available, they can go over what those cities, what the parameters of those grants are. And you can come up with your, if you know of a entity that has a grant, we can entertain it. But the key is that when you're stacking grants, you just don't want to go over the 20% rule, 20% down payment. So if you're buying a $100,000 house, you want to keep that loan amount at $80,000 or above. You don't want to go anywhere below $80,000 because then all the grants that I know of go away because it tells us that you don't need the grants. And the intent here is for use it to people that actually need it.
Thank you.
And these grants, these two grants, they're not for first-time home buyers. For example, let's say, I believe we have a pretty young audience, but let's say that one of your parents or grandparents, got an elderly couple and they're on fixed income. And unfortunately, one of them passes away and they live in a big house or a bigger house than they need. Now you're down to one person and they say, okay, I want to move into a ranch or a condominium ranch, something that's, easy for me to live in. So they sell their current home and they will go look at the purchase, let's just say a ranch. They can use these grants, even if they're downsizing, because it's not dependent on how much money you have in the bank. It's about your income and the location of the property. So if you get an elderly person putting 20% down, we would give them 3% of that, and we would pay all their closing costs, and they would get a below market interest rate, and they can keep the money in the bank. So this really does apply for a vast number of scenarios, just as long as you're purchasing your primary residence. So let's go to the next slide. So when we layer these two grants together, we can give you up to $10,000 for the down payment, $7,500 for the closing cost. And we have a loan program called the Affordable Loan Solutions, which allows a minimum of 3% down. So when we layer these, we could actually give you $17,500. The key is for the down payment grant at 3% though. So if you're purchasing a $200,000 home, we can give you $6,000. for that in the 7,500. And if you're buying a $150,000 home, we can give you $4,500 with the $7,500. That's $12,000. $12,000 is a tremendous amount of money when you're buying a $150,000 home. And in this page, you can see down at the bottom of the Bank of America, we have a down payment center. You can go into that and research other options, or these options and other options. For someone who's buying their first home and they take these programs seriously, you can get that weight off your back of a landlord, or maybe you live in rent-free with somebody that you're family members that you're just tired of. I know I was in that situation at a very young age, but I was tired of it. But these grants weren't available, so I had to wait till I saved up a lot more money. But I did it. But with these grants, you don't need to. You don't have to save that money. You just have to be responsible. Responsible employment, responsible savings. Yes, we want to have, you're going to need some money for the transaction, and responsible credit. And I believe in one of the previous sessions that these people experienced, that they went over the importance of credit, the importance of making your payments, the importance of not having too much credit out there with the balances on it. It's all about being a responsible individual or individuals. You can do this with significant others or friends or spouses. Let's go to the next loan program. Next slide. This one is very important. There's not too many loan programs. In fact, there's very little loan programs out there that you're allowed to put as little as 3% down. On an FHA loan, the minimum percent is 3.5%. But on this affordable loan solution, you can put as little as 3% down. And again, the key here is competitive rate, down payment 3%. It says for qualified home buyers, meaning credit, income, employment. And you don't have to have a lot of money in the bank. This is ideal for people that unfortunately may be, well, fortunately and unfortunately, because they have a college education, but they're now paying on some student loans. Congratulations on the education, but now you get student loans, but we take that in consideration. And we'd rather have you pay on your student loans, and we would help you with your down payment and your closing cost. That's the key. Be responsible, pay down your student loans or whatever other debt you may have, and let us help you with the funds. So some of the highlights here is the competitive rates with a down payment, okay, 3%. Mortgage insurance is required. Let's go to mortgage insurance real quick. When you put less than 20% down, you're required to pay private mortgage insurance on with this loan program. But the mortgage insurance that you pay on this loan program is significantly reduced compared to other conventional loans, other lenders. Also, non-traditional credit. This is very important. You don't necessarily have to have a credit history to use this loan program. In fact, you don't have to have a credit history, but you would need to have bills in your names that you've provided proof that you've been making payments on. For example, rent. If you're renting right now, we would want 12 months proof that you've been making your payments on time, and a copy of your lease, and that indicates how much money you're supposed to be paying. And then we would do something called a verification of rent with your landlord to confirm that you've been making your payments on time. We'd want another account, could be utilities. In fact, we would want 2 more accounts, and it could be utilities, could be a phone bill, but we want to make sure that you've been making your payments on time for a minimum of 12 months. Now, what's really nice about this is that these don't have to be debts, meaning that non-traditional credit. If you were disciplined and you kept on saving, let's say $100 or $200 a month every month for the last 12 months, and you kept on putting in your savings account, and you provided proof to me that you did that, I mean, a copy of each statement, I can see the money going into your saving money. That counts for a non-traditional credit. There we go. I'm back up in live. Non-traditional credit, not too many people go down that path, but it is very available and very, in fact, it's very competitive. Because some people don't believe in credit. They believe in paying for cash for everything. Those type of people can apply for this and use that non-traditional credit to help purchase a home. Various properties are available. So you're looking at primary residences. So you're looking at a single family home. You can look at a duplex. You can look at a townhome. You can look at a condominium, and even co-ops even are an acceptable property type. And that's kind of rare. And the next bullet was non-occupant co-borrower. So let's say that you're looking to purchase a home and it's the first time out of college, maybe your income is not where you want it to be, but everything else is lining up because you're a very responsible person. You can have a non-occupant co-borrower apply with you to help you qualify to purchase this home. That is, again, something that's very rare. So if you had a parent and say, hey, okay, I can help you out. You did great in college. Great. Let me help you laying down your feet and getting your own place. A non-occupant co-borrower can be allowed on the application. For the 3% down payment mortgage, so you're going to be using a down payment grant. When you use the down payment grant, the home buyer education is required. And it's a lot of good information, especially for a first-time home buyer, so they get a full understanding of what they're getting into. There are other loan options to use secondary financing, which is not typical, but if you want to, and they're out there, more than happy to entertain this secondary financing. And if you have generous parents or someone else, a fiance, church, a nonprofit organization, they can gift you money to help you with your cost. Let's say that you get $100 in the checking account, and that's it. Say, how am I going to pay for my future insurance, and how am I going to pay for my future taxes? Gifts are allowed. You're going to have to document as a gift. But these bullet points, these caveats they're so important to help you get into a home. And what's nice about our loan programs and the loan parameters is that you can have a 50% debt to income ratio. And that's rather very generous debt to income ratio consideration. But if you're making too much money, the grants can go away. And it depends on the geographical location. But for the purpose of Wayne, Oakland, Macomb County, Livingston County, St. Clair County, all the way goes up to Port Huron, Washtenaw County, these grants apply. I think Washtenaw County, the down payment grant does not apply, but the American Home Grant does. In fact, I'm positive about that. So depends on where you plan on purchasing. Most people that I'm aware of using this program are purchasing within Wayne, Oakland, Macomb County. And if you happen to be a non-permanent resident alien, These loan programs are the same for a regular US citizen. So I'd like to stop right now and see if anybody has any questions.
We do have a couple of questions from the chat. I'll ask two now, and then I'll ask two when we get to the question and answer session. How much money is too much money for grants to go away?
Great question. How much money is too much money for grants to go away? Depends on what county that you're looking into. When you say how much money, we're talking savings is irrelevant. You can have $100,000 in your savings account. That's irrelevant. It's more or less about income. And those numbers are updated often.
Okay, that leads us into one of our next questions. One of our next questions came in a private chat, and it is, so I'm interested in purchasing a home with my husband, but I'm currently not working, but he is. Can we still buy a house if just one of us are working? And can we both purchase the house, or just one who is currently working?
Great question. Let's go first of all, congratulations on being married. That's nice. And you're not working, but your husband is. So the question is, we look at the scenario in all different aspects. Meaning, let's say that you were working, and if your combined income was too high, then what we do is we take, let's say, you off the application. Your name would still go on title, but let's say that your husband's credit was fine, his employment history is fine, and his income is fine. Then what we do is we take the spouse off the application, and we go forward on the loan application with just the one spouse. Husband, wife, doesn't really matter. So, but both names are on title. So, worst case scenario, something happens to one spouse, the other spouse gets names remains on title and the house is theirs. So we look at it all different aspects. We look at whatever the current income requirements are, and then we look at the actual income of both parties, or maybe just one. But let's say that in your current scenario, let's say that you have debt on your credit report that is not associated with your husband. We may not want to include you on the application just because, well, first of all, you're not employed, and we don't want your husband to necessarily need to absorb that debt that you may have on your, could be a small credit card, whatever the case may be. That way, when we pull your husband's credit report, we look at his income, we're just qualifying him on his merits. Hope that answers your question.
Thank you.
The income guidelines are very relaxed. I mean, people like, oh, wow, they're just like, they're, we're not even coming close to that income yet, and we still qualify. I'm going to do some quick math. And I'm going to just give you the number for Wayne County. Those are the ones I know off the top of my head. So Wayne County, if you make $58,240 or less, you automatically qualify. But we're also going to be taking a look at the property and finding out what kind of income track level it is in. There's 4 categories: low, moderate, middle, and upper. If you're purchasing a property that's a low or moderate track level, your income has to be $109,200 or less. So it all depends, and most properties in the city of Detroit are considered low or moderate. Therefore, your income limit is most likely to be $109,200. So it all depends on what area you plan on purchasing. For example, the city of Redford, I know that Redford is pretty much almost cut in half, where half the properties are low to moderate, but and that's on the east side. On the west side, the other properties are middle and upper. So it all depends on the very specific property address. And whether or not, well, I'm going to go into the next screen and I'm going to get into something. Now I want you to, all right, we're going to go back to the previous screen. And I'm going to talk about something that's not on these slides. I want you to put everything that I just told you on the back burner, because we have a new loan program that came out. What we've been talking about is at the top of this page is called Affordable Loan Solutions. And everything I've said previously applies to that. We have a new loan program called Community Affordable Loan Solutions. And this is so new that we don't have marketing material. We don't have a slideshow for this, but I'm going to give you some information on it. This loan program is for Wayne County exclusively, and it's for properties that are considered in the multicultural census tract areas, meaning that according to our government's definition of that, that means a certain area within the county has to be either 50% African American or 50% Latino. So I'm just going to pick out a few cities. Let's say the city of Harper Woods, which is at the northeast corner of Wayne County. That entire city is in a multicultural census tract. The city of Hamtramck is not in a multi-central census tract. The city of Detroit, a majority of the properties are. The city of Highland Park, majority of the properties are. River Rouge, in fact, all the properties are. If you go down to, let's say, Livonia, that's not a multicultural census tract area. So even though it's in Wayne County, those properties do not qualify. Westland, the properties don't qualify. If you go down to Trenton, properties don't qualify. They're not multicultural. But if you go into Oak Park, if you go into, I'm not thinking Oak Park, but I'm thinking Lincoln Park. Then we're going to look at very specific properties to see whether or not they're in a multicultural census tract. The key here is that we're not going to give you 3% of the purchase price. We're giving you $10,000. So you could buy let's say you're on the east side of Redford and you bought a $100,000 home. We're giving you $10,000 for the down payment. And we're going to pay your one-time closing cost items. And you're not required to have a minimum credit score. On the Affordable Loan Solutions product, we talked earlier, one thing I didn't bring up, but your minimum credit score is a 640. But our Community Affordable Loan Solutions, there's no minimum credit score. Your debt to income ratio is 50% on the Community Affordable Loan. There is no mortgage insurance on a Community Affordable Loan Solution. The income limit is 150%, meaning that in Wayne County, as long as you make $109,200 or less, your income automatically qualifies. You are required to take a specific home buyer education course that pertains to this Community Affordable Loan Solution product. And this is only offered in like 5 regional areas of the United States. Detroit, Dallas, Los Angeles, Miami, and Charlotte. So if someone was talking earlier that they want to move to Dallas, this loan program exists and we can give you $10,000. If you're moving to Miami, if you're moving to Los Angeles, that down payment agreement is $15,000. So if you plan on relocating to Miami or Los Angeles, this is a very live program for you also. We will pay for the one-time closing cost items, except for this program will not pay for points. So it still minimizes, well, significantly minimizes the amount of money that you need because you're paying your closing costs and we're giving you $10,000. So if any money, you may consider just paying points on your own, just get a lower interest rate. That's the loan program that I don't have any marketing material on because it's rather new. Let's go to the next slide. Depending on your intent, you're most likely gonna want to select a loan product that complements your long-term plans. You may want to buy a home and be in and out of it in 5 years, or maybe 7 years, or maybe this is the home that you're going to be in for the rest of your life. You're going to pick the right loan program to complement your needs. In a low interest rate environment, our interest rate environment came up significantly, probably doubled in the last 14 months. So we're not in the lowest interest rate environment, but we're still in a relatively low environment. Anywhere from 6.5% to 7.5%. And in that range, it could be considered a low environment. But if you plan on being out of the house in 5 years, because whatever the case may be, then you want to consider an adjustable rate mortgage where it's fixed for the first 5, 7, or 10 years. You want the loan program to complement your intent. But if you found a home and this is it, and you're putting $10,000 down or putting 20% down, and you want to eliminate all the interest rate risk, you can go for fixed rate mortgage. Those are just the loan types. Now, if you go into loan products, you can get a conventional loan. If you can get a VA loan, you want to entertain that. Also, look at all the very specifics. A Federal Housing Administration or an FHA loan, again, 3.5% down payment. You want to entertain all those loans based on your intent and based on how you would qualify for each. And some of these grants apply, all the grants apply towards the conventional FHA and the VA loans. The down payment grant does not apply to the Federal Housing or the Department of Veteran Affairs. Both the Community Affordable Loan Solution and the Affordable Loan Solution products are conventional loans. Those are the loan types. So those are all considered a conventional conforming loan. The other two can use the American Home Grant, but they're not considered conventional loans or FHA or VA. And at the bottom of this page, you can see in the blue hyperlink, there's a Better Money Habits. Better Money. We have a program here at Bank of America that goes over better money habits. You're coming out of college, or you've been around just out of college, you want to get into a better savings program or understanding better spending habits, better saving habits, better earning habits. But the umbrella above all about this is being a responsible person so that we can help you increase your net worth by ideally purchasing a home. And I'm going to go to the last slide, which is slide number 21. And this basically explains the process. The very first process is the next step after this conversation. You're going to talk to someone like me, or if not myself, and you're going to get pre-qualified. You're going to submit a preliminary application. You're going to turn in some documents, W-2s, pay stubs, bank statements. You're going to give the loan originator permission to pull your credit report. You're going to let them look at the whole scenario and see what's in your best interest. See what grants can apply based on your intent, the intent to purchase a certain type of property and the location of the property. And then once you're pre-qualified, you're going to get a letter, pre-qualified or pre-approval. You're going to get a letter that you're going to carry, and you're going to hand to a realtor and say, you know what, I'm going home shopping. They're going to want you to have that letter in your hand because they need to know that you're serious. And so does the seller of the property, because they're going to only accept serious offers. And if they accept your offer, everyone completes their portion of the purchase agreement. And then you go back to your lender and say, you know what, it's time to me apply because, we got a closing date that's coming up in 45 days or 30 days. And we need to make sure everything happens. So you're going to you're going to go to your lender, you're going to submit the application, you're going to trade any additional documents that you need to. Maybe it's an updated pay stub, maybe it's an updated bank statement. And maybe a proof that you've been making your payments to your landlord for the last 12 months. And a copy of the lease, things like that. You're going to need to provide, and you're going to be signing some disclosures indicating that you're giving the bank permission to order all the documents they need to in order to process your loan. And then as the back office works on your application, the underwriter hopefully will provide a conditional approval, meaning that as long as we get good title work and get good homeowners insurance on the property and the appraisal comes in 5, we can continue on to the final approval. And to say all those comes in fine, you got good title to the property, the appraisal came in fine, you provided home insurance on the property, you committed to a company and they provided you an invoice and we're going forward. We get the final approval and then we're going to share with you again all the numbers expected at the time of closing, called the closing disclosure, in advance of the closing. And we're going to explain to you all the numbers so that 2 or 3 days in advance, you know exactly what numbers you're going to be required to get a certified check for, or maybe wire money directly to the title company so that they can conduct the closing on the day that it's scheduled. So with that, I'm going to sit back and ask if anybody has any questions. We have about 9 minutes left. I can answer a lot of questions in a short period of time.
That is awesome because our question box has blown up. So let's start. One question that we have is, let me go up here. One moment, please.
Why don't you give me 3 or 4 of them and I'll decide which, I'll order them in the proper, so I know how to, they're blown up, so.
I'm actually gonna go by the latest to the last. They're kind of talking about what you just spoke about, so going backwards. So do teachers get a percentage off of their homes in Detroit if they're first-time home buyers?
Not with Bank of America. If there is, well, I want you to be careful. I want you to keep your ears open for the next month and listen to what Mayor Dugan has to come out with.
So
I'm going to answer it that way. I don't believe teachers have an advantage, but I want you to listen to Mayor Dugan in the next month.
So some important messaging coming from the mayor's office.
Correct. Important information coming out from your mayor's office. Yes.
Okay. Can you take a loan out for remodeling a rundown home if you're interested in purchasing it?
All the homes have to be in marketable condition, meaning that the appraiser has to go in there and make sure everything is fine. But if there's a health and safety issue, and let's say there's mold in the basement, that stops everything. If your kitchen countertops are missing, that stops everything. If someone's in the middle of remodeling the bathroom, that stops everything. It has to be marketable. So someone that can actually purchase the home can walk in there, turn the key, and move in.
Okay. What if you have paid your rent late just 1 month, but the rest of the year you've paid on time? Does that affect your chances to receive assistance?
Late meaning over 30 days. If it's over 30 days, it does. You have to wait to get 12-month good history.
Okay.
So if you're 25 days late, it's irrelevant.
What should you avoid when buying your first home? What sort of things should you avoid having purchased recently or on your credit when you're trying to buy your first home?
We don't want you to go out and get a brand new car and have large payments. We want you to have your minimum payments required so your debt to income ratio is not at risk.
Okay.
Ideally, we want to have credit open on your credit. Ideally, I want to have 3 accounts open on your credit report that you've been making payments on for over a year in good standing. That's the ideal scenario.
What if you're just starting to build your credit and you want to purchase a home? So maybe you don't have such three. What would you suggest?
It all depends if you can't do the non-traditional credit. Some people don't have bills in their name. They don't have, they're living rent free and they don't have utility bills in their hand and they don't have, they don't even have their own phone in their name, so they can't prove they have making payments. Then I suggest you go out and open 3 accounts, maybe. I'm just gonna throw something up, either Sam's Club, Costco, Bank of America. Get some secured accounts going and keep the accounts open. And ideally, when we want to see a minimum of 1 year.
So from beginning to end, how long do you believe the home purchasing process works from application to ownership?
30 days.
Awesome. Well, we want to thank you so much, Alan, for joining us today and Bank of America. As you see, Alan's contact information is on the screen. So if you have any further questions or comments, feel free to reach out to him at Bank of America. And he's also in Roseville, so very nearby campus. So that's awesome. Once again, this is our final session for our Kickoff to Financial Freedom. So I want to thank you all for joining us. And each of you who stayed for our presentation have received 1 entry into the drawing to win our free Chromebook. So stay in contact with me, as you see my contact information on the screen as well, Shantae. And we look forward to having you join us in our upcoming events and activities, keeping you in the loop. Thank you so much, Alan.
Thank you for allowing me to present today. Don't hesitate to reach out to me. Thank you.
Yes, my pleasure. Thank you so much.
Bye.
Bye.